Hello and welcome to GIBS Business. We're joined in studio by Matthew Birtch, Senior Faculty Member at GIBS, to discuss the ongoing crisis in China. Matthew, welcome to studio.
Thank you.
Matthew, before we discuss the happenings of Black Monday, what is happening in China?
I think it's fascinating what's going on. There's a few major impact and events that have taken place this month, really. Obviously, we've seen a huge devaluation in the Shanghai Composite. We've seen a devaluing of the RMB. And really, it's China's stepping into the new realm of its new economy of rebalancing to a domestic consumption versus investment-led growth path.
The old phrase that when America catches a flu, the whole world suffers, now seems to apply to China.
Absolutely, and I think particularly even more so for us in Africa for emerging markets. I think there's obviously interconnections between both the Chinese government and the US government, but certainly what happens in China now has an impact globally because they're so integrated into the world economy, but particularly in emerging markets because we've been facing east towards China greatly over the past 10 years.
Modern economies are driven on information, but there seems to be some discrepancy in what's coming out of China. You're seeing good growth numbers, but on the other hand, a lot of market watchers are saying that those growth numbers aren't true.
Well, you've got two types of commentary in China. You've got Western journalists that look at China and they have one comment, but you've also got, journalists from East Asia and internally in China that see it on the other side. There's certainly a degree of opacity when it comes to this. And we see Li Keqiang, the finance prime minister, effectively talking about 3D printing in China, but not even mentioning the $200 billion prop-up of the Shanghai Composite Index or $200 billion that they've put into the RMB to stop it from sliding even further below that 4.5% level. So it's very interesting what's going on at the moment. There's still $3.6 trillion in reserve. So it's not in a situation like other economies, but they're certainly eating into it as fast as they were generating it at the moment.
Matthew, on the other hand, you've also got private sector debt that's growing in China.
Yeah, a huge amount of private sector debt, but we've still got an economy in tier one cities that is growing at a rapid pace. I think, being in China recently over the past couple of weeks, it's still business as usual in tier one cities. That said, there's still been a feeling that the government is, how much can they intervene? So we see the government putting in $200 billion into the Shanghai Composite, but I think they realized it was fruitless. You can't fight gravity, and there's going to be a monetary loss there. And I think that was a capitulation as opposed to a disaster in terms of what's been wiped off. We have seen a huge amount of money being wiped off the Shanghai Composite, 3.2 trillion. It's the same GDP as Brazil. So there's large numbers here, but it's certainly not an economy that's indebted, which makes a huge difference in terms of how it can react.
Does the Chinese economy not remind us of what Japan went through in the 80s?
I think there's a lot of similarities, but I think the fantastic thing that China can look at is look at their monetary policies and see what Japan did incorrectly or correctly. Also, the size of the economy is huge, and it doesn't have the same age as Japan. So I think there's some fundamental differences, but also foresight in terms of what's happened. But it's going to be a rocky road over the next year or two for China when it's transitioning into that domestic-led consumption type economy.
Of course, we saw in 2008 the financial market crash was cushioned by demand on the Chinese side for commodities, and that led to countries such as South Africa being able to weather the storm in a way. What now is the fallback?
Well, I think we've seen commodity prices being peppered because of what's going on in China. We've seen kind of bear markets happening on the DAX and in certain other indices in the Eurozone. And so unfortunately for South Africa, it does not bode well because of commodity prices. We've seen the oil price shock as well going forward. I think the fortunate thing is we have doing a lot of trade with China, so it should improve over time. But certainly commodities don't bode well, especially in terms of South Africa, where we're already, it's binary what we can actually get out of these mines now, and it's becoming even more challenging to extract minerals and resources. So I think we're seeing a big shift in that domain.
Matthew, the devaluing of the Chinese currency last week has pointed out how interconnected we are from a monetary perspective. What are the implications on that for the world at large?
I think what we've seen is quantitative easing happening from the US. We've seen that kind of spread to the ECB, and it's basically shifted debt across into emerging markets. And China's responded by devaluing the currency. Obviously, it slid by 4.5%. It almost went off a cliff before they stepped in and put another $200 billion into it to try and peg it even closer. And I think that's going to have a big impact on what the Fed does, because the Fed is going to have to raise interest rates quite dramatically to have any kind of impact. But it's natural that we were going to go through this. China is rebalancing, going from an investment-led economy to domestic consumption, and the Western world has to be weaned off rock-bottom interest rates.
Coming back closer to home, South Africa and Africa's economy has largely been spurred. The growth spurts have been spurred by China. What are the implications now now that we're seeing an easing of Chinese infrastructure-led growth?
Absolutely. I mean, we saw Angola being the world's fastest growing economy globally from 2000 to 2010, and that was predominantly its linkages to China. Obviously, the oil-based economies in Africa are going to take a huge knock with the oil price devaluing. I still think there's a lot of legs in terms of trade with China. I don't think it's a total crash at the moment by any means, but I think it is a wake-up and a realization that the Chinese government is going through this transition period and that they don't have absolute control of absolutely everything. We see the 200 billion that they put into the Shanghai Composite, the index in China effectively, and they stopped doing that because they realized they couldn't fight gravity. If shares are going to plummet, they're going to plummet. I think it's going to have, in the short term, quite a negative impact on sub-Saharan African countries, but I still firmly believe in the long term, lots of growth out of China over the next 10 years.
What are the policy directions that Southern African countries should be looking at?
Well, I think they're back to the simple ones. We have to diversify the economy. We can't be, susceptible to commodity price shocks, for example. We know the super cycle is over. We have to create more businesses. And fundamentally, we have to trade with one another. And I think those policies haven't changed. Regional integration, ECOWAS, EAC in East Africa, for example, that kind of ideology of creating beneficiation with our products as opposed to sending them raw and then buying them back at higher rates. I think those are the same policies that we need to generate that we've been discussing for the past 10 years need to start taking effect now.
Will we see the Chinese take a more involved stance, such as in the BRICS Bank going forward, or will there be a...
I think the Chinese will always be, because of the size of the economy and the volume of the economy, they'll always be big players with the likes of a BRICS Bank. We see their one belt, one road policy in terms of kind of logistics integration. The AIIB, which is the Asia Infrastructure Investment Bank, very importantly, America not a member, counterweight, again, to the World Bank, if you like. And America probably made a faux pas in terms of not getting involved in that AIIB. So certainly you're going to see a lot of activity from investment. And obviously, the reason why this is quite important for the Chinese is they've got a huge drive to internationalize the RMB, to make it a reserve currency. That's a soft power projection mechanism, and it allows them to do a lot more with their economy when we're all kind of exchanging in RMBs to Australian dollars or RMBs to, the pound sterling, as opposed to that US dollar flip. And I think that's a big part of what they're trying to do with the currency. Obviously, they want to get into the IMF and loosely peg it more, but that's going to take some time, especially with the kind of noise. We must remember we've only had a 4% drop. Japan and Brazil have devalued their currencies much greater than that over the past year or two. And that hasn't hit the headlines like China has. So China's certainly under a spotlight. And I think a lot of companies have not maybe hedged themselves outside the China story. It's been such a tough nut to crack for so many businesses to get in there and make it work, that they've focused all their energies and efforts there. And all of a sudden, if there's a bit of a slowdown in the economy, it has a detrimental impact to companies. If you look at the likes of Glencore, for example, who's taken a real knock over the past 6 months in their share price, is because they haven't hedged themselves outside of the China story.
When we look at these events of 24th August 2015, will we see this as a changing moment or defining moment in the global economy?
I think it's been a huge drop. I mean, we've seen some quite fundamental changes. I mean, obviously the rands was the lowest the other day than it's been since 2001 to the dollar. We see Black Monday, 8.5% drop in the stock market. And it's a rebalancing. I do think there will be a bounce back up. It's just natural. When something goes down, it will come up. But it's got to settle at a rate. And
so it's not a long-term systemic change?
I don't think it's a long-term systemic change. I think it's an indication that change is happening and they're struggling to manage that loosely. And I think there's been good learnings in Beijing that you cannot control some things. Other things you have a lot more impact in. Other things just have to kind of naturally integrate into the world economy.